Bloomberg Audio Studios.
Podcasts, radio, news.
Jennifer Lee joins us. She's a senior economist. She's a managing director at BMO Capital Markets. Jennifer, as we think about 2025, I'm not even sure where to start. I mean, let's just start. We've got a new administration coming in the United States. We've got a new Congress about to be seated in the new year. What do you expect from, again, the new sheriff in town from an economic perspective? I don't know if it's, tax policy, if it's tariffs, if it's, changes in immigration policy. There's a lot of moving parts. How does that impact your outlook for this U.S. economy?
Well, good morning. Happy holidays to you both, and thank you very much for having me on. This is it's that key word, uncertainty. Expect the unexpected. There is so much unknowns as we're heading into the new year with the new Trump administration. He's already talked about what he plans to do, everything that he wants to do on his to-do list. Whether or not he's going to be checking them all off on day one, that will be very interesting to see. But certainly tariffs is the key measure that he's planning to roll out. He's already talking about the 20% blanket tariff on all $3 trillion worth of goods coming into the U.S., and that will be already significant compared to what he did back in 2017, which was, targeted tariffs on about $300 billion worth of goods. So this is a bigger impact. And of course, 25% tariffs on Canada and Mexico, an extra 10% on China. Maybe this is on top of the 60%, so I'm not sure what the figure is going to be. So there's a lot of uncertainty, I think, heading into this new year. But tariffs are certainly the key factor. Taxes, corporate tax cuts, targeted tax cuts, I think, which would be great for corporate America. And of course, different tax relief measures for those who are earning overtime, Social Security, and of course all those other issues like the biggest deportation effort ever in the U.S. Cleaning out all the extra stuff that doesn't need to be spent. That's where DOGE comes in. So a lot of things on his to-do list, but how that's going to play out remains to be seen. And I think this is why we're expecting a lot of uncertainty as we start the new year.
The latest estimate for the Atlanta Fed's GDP Now model for the current fourth quarter, actually above 3%, Paul. And of course, we were talking about earlier the economic growth projections. If you look at the ECFC function in the terminal, that can pull it up for you on a quarterly as well as an annual basis. So, Jennifer, I'm curious because year after year, especially coming out of COVID, there's so much doom and gloom, even for the expectations in 2023, 2024, that a lot of economists ended up being on the wrong side of that and getting it wrong. So what are people getting wrong about next year? Because I feel like once we wrap up a year and look ahead, we always have these kind of anticipations that never quite come to fruition when you look a year out.
That is true, and we have been, I think, on too low on our growth expectations. We were never in the recession camp, thankfully, but I think everyone was always too low on their growth expectations. We've got about 2.25%, just under 2.5% penciled in for next year. Where I think the miss has been is certainly from the U.S. consumer. The U.S. consumer continues to be the big driving force of the broader U.S. economy. That, and of course, over the past few years was all the business investment and government spending as well, helped with the CHIPS Act and the IRA. That certainly helped boost the economy. But the U.S. consumer continues to surprise, and we should always say never, ever underestimate the U.S. consumer. Just the last November data for personal income and spending showed continuing spending. It wasn't exactly super strong, but it was still they were still spending. And also in those areas that if things were really tough, they wouldn't be spending on, like recreational goods and services, recreational vehicles, that area. There's a bit of a pullback on dining out, hotel stays, but overall still decent consumer spending. Still decent consumer wages. Savings rate just over 4% is still pretty decent as well. So I think that's where the mistake has been. So we'll have to see how things go in the coming year, just given that we are expecting inflation to tick higher.
So the dollar just in this last 3 months is up, nearly 7%. And for the Tom Keens of the world that like to, vacation over in Rome or
That's
Paris
right.
or London, it's a good thing. What do you make of this strong dollar, Jennifer?
So the strong dollar has been, at the beginning, it was a function, I think, of the stronger U.S. economy. Like throughout 2024, the mistake has, I think everyone has already underestimated, global growth as well. I don't think there was one G7 country that had back-to-back negative GDP reading. So nobody was in an official recession. Things got revised a lot, which I thought was very interesting. It's just on the data front. But everyone ended up stronger, I think, than expected, especially in the U.S. So a lot of that U.S. dollar strength was reflection of much stronger U.S. strength relative to everyone else. And now, over the last few months, it's been a reflection of, I guess, Fed expectations, at least over the last few weeks in particular, just given how everyone's expecting the Fed to not cut as quickly as originally had been anticipated, just given, again, incoming tariffs, potential impact on inflation. And now with the last dot plot showing only 50 basis points of rate cuts penciled in, which, by the way, I think we sort of have to take with a grain of salt, that certainly put a little new fire underneath the greenback. And that's been very, very difficult to make good calls on the currency market, just given all this volatility. So the Fed not cutting as quickly or as much, everyone else seeming to face slower growth as we're entering the new year and more rate cuts coming, like from the ECB, from the Bank of England, maybe not the Bank of Japan. The RBA is probably going to start cutting rates in February. That is going to also weaken their currencies and put more strength underneath the US dollar.
I'm curious, as the calendar flips to 2025, the Fed, of course, will have new voters. Who are you keeping a close eye on for as we get closer to what people are arguing debatably, that neutral rate? Who do you think is more of a close call on dissents here?
Well, you know what? I think I'm going to go back to just to see what I think Fed Chair Powell is going to be the key Fed policy maker, of course, that makes the key decisions. And whatever he says sort of reflects, I think, the broader consensus. So I think I'm going to keep listening to what the Fed chair says. I mean, everyone else has their own opinion. Everyone has their own dots. But I think ultimately it's going to be up to the Fed chair to make that deciding factor. So I'm just going to go straight to the boss and say it's going to be Fed Chair Powell.
Jennifer, you're up there in Toronto. How are our good friends in Canada thinking about this new administration, maybe some tariffs? Because last I checked, we do a lot of trading with you guys up there.
Yes, the U.S. is our biggest trading partner. 75% of our exports head down to the U.S. So obviously, we were already pretty nervous because the USMCA is up for renegotiation in May of 2026. So we already knew that there was something going on that front. And now with the new threats of a 25% tariff on both of the U.S.'s trading partners from that deal from both Mexico and Canada, obviously makes us very nervous. And we're going to have to see if we are going to be able to do some, decent negotiations that will hopefully, soften the blow, and hopefully we won't see this play out. Even if it's also going to depend on how long, if he does do what he threatens, which is the 25% tariff on Canadian imports, how long that's going to stick around for. And, hopefully it's not going to come to fruition, but there will be very bad news for our Canadian economy. But we've got about 2% penciled in for Canadian GDP growth this year, or for next year at least. Rate cuts have had a good impact, but all that could be erased if we do see a blanket 25% tariff on all Canadian imports.
All right, we'll stay on top of that for everyone. Jennifer Lee, Senior Economist, Managing Director at BMO Capital Markets. We appreciate getting some of your time.